Welcome to Part 8 of our Financial Statements video training. In this video, we point out important information that is derived from the balance sheet, including a company's working capital, current ratio, and financial leverage. We also direct your attention to the notes to the financial statements for important information. A comparative balance sheet is also presented. Please print the PDF handout shown below this video as it will be used throughout the training. Okay, we're going to go to the handout balance sheet. The balance sheet allows bankers and others to quickly determine how much a company has in working capital. Now, working capital is defined as current assets minus current liabilities. So, in that balance sheet that we just reviewed, the working capital would work out to be $330,423. And I got that by taking the amount of the total current assets, which was $463,823, and then subtracting the amount of the total current liabilities, $133,400. Okay? So working capital, right? So your banker is going to say, does this company have any working capital? How much do they have before I talk about getting involved with their business? Okay, the next thing we have to mention is those same two things, current assets and current liabilities, are compared. And we have a thing called the current ratio. And what we do is we take the current assets, the total amount of current assets, and now we divide by the total amount of current liabilities. And using those same numbers, the current assets of $463,000 something, and we divide by the current liabilities of $133,000 something, we get a current ratio of 3.5. And sometimes we say our current ratio is 3.5 to 1. So either way would work. Yes?
Going back to the working capital definition, which is the total current assets minus the total current liabilities, isn't that the same as the stockholders' equity?
No. The question is, isn't the calculation of working capital the same as the calculation for stockholders' equity? And the answer is no. Stockholders' equity was total assets, current and long-term assets, minus total liabilities, current and long-term. Okay. That's for stockholders' equity. For working capital, I use the word total to emphasize it's all the current liabilities and current assets. So, okay, so going back to working capital, it's total current assets and total current liabilities. The working capital and the current ratio are only as good as the amounts contained within the current assets and current liabilities. So again, if your inventory is overstated, you're overstating your working capital. All right, the next thing I want to mention is a thing called financial leverage. And leverage means how much debt do I have as a proportion of the asset. So if I purchase a $10,000 asset and I use $10,000 of my own money, there's no debt involved, right? So $10,000 of cost, $10,000 of my money, no leverage. But I might like to acquire a bigger asset, but I only have $10,000. So if I take my $10,000 and borrow $40,000, I can now purchase a $50,000 asset, right? So now I'm leveraging, right? I'm able to control a $50,000 asset with only $10,000 of my money. And so debt is good to a degree, right? Because if those assets go up at a higher rate than the interest I'm paying, I'm going to come out very well. My $10,000 might mushroom very high. However, as we've seen in the real estate market in some states, a lot of debt, high leverage, doesn't work so well when the values of the assets drop. So that when the asset value drops, you still owe all that debt, and it may wipe out all of your money, right? So everything gets a little more multiplied when you have debt. So you want some debt because it's pretty prudent and wise from a business sense, because usually the interest isn't very much and it's income tax deductible. So we can rationalize debt, and in our own lives, we like to live in a nice house and we can't pay cash. So it's logical to have some debt, but if you have too much debt, it's risky. And the other thing that's going to happen, if you have too much debt and you go to your banker for a loan, the banker's going to say, gee, you already have this amount and I'm not going to have much collateral because your assets are already pledged. So you're too leveraged. I can't make the loan. It's too risky because you owe too much already. Okay, the last thing I want to mention is that the notes to the financial statements include the notes that pertain to the balance sheet as well as the income statement. And so the notes to the financial statements have lots of information on our balance sheets, including leases that we